All right, let's get straight into it because today was an absolute bloodbath in the crypto markets. We saw a massive wave of selling that has everybody talking. Bitcoin completely smashed through its key support levels, and, well, the entire market is just a sea of red. So what in the world is behind this move? And more importantly, what does it mean for your strategy? Here it is. This is the headline number that's causing all the chaos. Over the last 24 hours, institutional players yanked a staggering $866 million from the spot Bitcoin ETFs. Now, to put that into perspective, that is the second largest single-day withdrawal in the entire history of these funds. Just a massive, massive shock to the system. And you can see the immediate fallout right here. Bitcoin is down almost 7%, and it is desperately, desperately trying to hang on to that last major support wall at $95,000. But look at Ethereum. It's getting hammered even harder, down over 10%. The pain is absolutely widespread, and it is severe. So this brings us to the million-dollar question, right? The one on every single investor's mind. Are we watching the beginning of a long, painful downturn? Or is this the kind of brutal, violent shakeout that actually creates a rare buying opportunity before the next big leg up? Okay, let's dive into this and figure it out. To answer that, you really have to follow the money. And in this case, it looks like the main driver of this crash was a huge, decisive move by Wall Street. You know, this chart gives us some really crucial context. That $866 million outflow, it wasn't just some random one-off event. Nope, it's actually the peak of 3 straight weeks of selling, with a grand total of $2.64 billion being pulled from these funds. This pretty much confirms it. The sell-off is being driven by a large-scale, deliberate withdrawal from the big institutional players. And that selling pressure from the institutions, it created this absolutely devastating domino effect. The initial price drop triggered a massive cascade of liquidations, wiping out over $1.1 billion in leveraged long positions. This is a classic leverage washout, folks. It forces traders to sell, which just dramatically accelerates the whole downward spiral. But hold on, because the story doesn't just end with Bitcoin's sell-off. If you look a little closer, you start to see this fascinating split in the market. While one part of it is bleeding out, other institutional-grade assets are not just surviving, they're actually thriving. It's really a tale of two markets right now. And wow, this chart just says it all, doesn't it? It perfectly illustrates that split in institutional money. As capital fled the Bitcoin ETFs, it poured into new products. Canary Capital's brand new XRP ETF just had the single strongest debut of any ETF launched in 2025. That's a huge signal that institutional interest isn't leaving crypto. It might just be rotating. You know, the success of that XRP ETF, it opens up a whole new playbook. It proves there's this massive pent-up demand for institutionally packaged altcoins, especially the ones that have some kind of regulatory clarity. This could easily spark a rotation of capital into other potential ETF candidates that traders are watching super closely, like Solana and Chainlink.
Now, the other big counter-narrative here is the rise of stablecoins. And this isn't just about traders running for safety. We're talking about giants like Fidelity publicly stating that they see stablecoins as the fundamental plumbing for the entire future of global finance. That is a huge statement.
And this isn't just talk either. It's being backed by some serious action. BNY Mellon, the world's largest custodian bank, by the way, just announced they are launching a stablecoin reserves fund. This is a massive, massive step in building out the kind of serious, institutional-grade infrastructure for the whole stablecoin ecosystem. So things are a little messy, right? We've got conflicting signals, total panic in Bitcoin, but real strength showing up elsewhere. How do we build a practical framework for navigating this kind of market? With all this fear in the air, how can we possibly think clearly? Well, we can start by using tools that help us measure the market's emotion, like the Fear and Greed Index. It's a classic contrarian indicator. Basically, when the market is euphoric and super greedy, that's often a sign to be cautious. And when it's terrified, like now, it can signal that sentiment has just become way too pessimistic, potentially creating a great opportunity. And where are we right now? The index is flashing a reading of 16. 16! I mean, that is deep, deep in the territory of extreme fear. Historically, market bottoms are very often formed during these exact periods of peak pessimism, right when the last of the sellers have finally given up and capitulated. Okay, so what do we actually do with all this? Based on everything we've seen, here's a simple 3-step framework. First, limit your leverage. That recent liquidation event was a brutal reminder of the risks. Second, monitor those key support levels really closely to see if the market is stabilizing. And third, keep a sharp eye on where that institutional capital is rotating to next. And speaking of support, this is the number that matters more than anything else right now: $95,000 for Bitcoin. If this level holds and we don't see another crazy ETF outflow, the market has a real chance to stabilize and form a short-term bottom right here. All right, to wrap this all up, let's look ahead. What are these specific, actionable things you need to be watching over the next 24 hours? There are 2 really important things to watch. First, tomorrow morning's Bitcoin ETF flow data. That number is going to set the tone for the entire market, period. Second, keep an eye on Washington for any updates on the Genius Act. That's the key piece of legislation for Stablecoin Regulation. Any positive news there could give sentiment a much-needed boost. Which leaves us with one final big-picture question. Was this massive shock just some random disaster? Or was it a necessary purification? A painful but maybe essential process of washing out all the excess leverage and rotating capital into new, promising sectors before the market can really start its next major climb? I'd love to know what you think.